you focus on early stage tech companies and junior companies in the resource space. Let's start with the selection process. What key criteria or milestones must a company meet to earn a spot in your portfolio?
So we start with developing our own thesis where we believe the world is heading, especially around technology. All the rage right now is AI work, and everybody, it's all exploding. We've been doing this for almost eight years now, and so we try to look at where we feel there's going to be innovation and the need for innovation, and then we search out companies that sort of meet those criteria, but they also have to be very scalable. And we only are interested in companies that can have significant growth. So what we do is for people, some people are familiar with ARK Investments, which is run by Kathy Wood, which is disruptive technologies, but these are billion-dollar companies. Of course, they can go out to be multi-billion-dollar companies. We do the same in the microcap space. So we'll get involved in companies at the seed and pre-seed round. We advise to help them grow because we have experience. We help them get the capital. And then our objective is to make a 50x to 100x on our initial investment. And then based on, as you say, milestones, that would trigger us, in many cases, investing further, because these are challenging things to start with nothing and create a real significant going concern. So as the project's de-risked, as milestones are met, we'll often commit more capital and bring more capital to the table.
I really like your approach, especially that it is needs driven. You first assess the needs and then look for the innovation and hopefully enter into an investment and then potentially scale up if the company meets certain milestones. And every portfolio has its standouts. So which companies in your current lineup are you most excited about, and what makes them particularly compelling?
Sure, and it's very timely now. We've been stealth for about 5 years in terms of telling our story. And the reason for that is that these things take time. And we're not interested in standing up and arm waving and going, we're going to be involved in this company and this is what they're going to do. We want to talk about what has been done, what has been developed, because there's no point going into the drama of the setbacks, which they all happen. Timing is just always delayed because, humans are optimistic. But there's a number of them in our portfolio. This is why this interview is so timely. We believe in the latter half of this year, we are going to have a number of companies reach the point where they're doing their IPOs or they're launching their products or the growth cycle is kicking in. So we have about 60 companies in our portfolio, and probably 10 are imminently commercializing, I would say, reasonably well. I can talk about one as a good case in point. It's a company that we've also been stealth on up until very, very recently, and the company is called AIML. It also happens to be its stock ticker. And this is a company we've been involved with for a few years and was involved in came out of COVID for telehealth through basically measuring your own blood pressure and remote monitor. During that development evolutionary cycle, we ended up stumbling on a company in Canada. We acquired it last year, and they've been working with supercomputers for 4 years, looking particularly at the ECG market, heart health. It is a market that has basically not changed in 60 years, and they've made a major fundamental invention. And what that is when one goes, and typically once a year, some people more, or some people who have had heart events have to wear halters and so forth, they have to have their ECGs taken to look at how your heart is doing. The signal to noise ratio in that is very, very challenging. What I'm saying by that is when you put the leads on a body and you try to read the charts that we've all sort of seen, the waves, the cardiologists, the technicians that read these signals are often guessing whether or not these individual peaks and valleys and so forth, without getting into technical medical jargon, is what's happening inside your heart, or is it the translation of that signal to the ultimate spreadsheet that they look at that is sort of interfering and showing other patterns that are not your body, but the noise in the data. And we have been able to, this is a profound invention, go through and eliminate sort of the noise and find the signals that affect what your true health position is going to be. And so right now we've been working with cardiologists. So this company has made it's come out of stealth, and it's made a couple of major announcements in the last week. One is they filed with the FDA, what's called a 510K. It's an equivalent device, which means, whoa, that they have to do a lot of development for that to take place. They've also announced their advisory board, and on the advisory board are Canada's leading cardiologists. And they all feel that this is the first fundamental change in heart diagnostics in 60 years. It's disruptive. It's going to, basically, in their view, it's going to predict heart attacks, strokes, and other events. So it's, and this is all being enabled through wearables. And the wearable market is exploding, where you're going to basically have sensors. So the natural ones people know about are your watches, because, you know, there's the Apple Watch, the Samsung Watch, and so forth, and they measure certain things that are going on. The problem is it's not medical grade, and the signal to noise ratio makes it so that a real practitioner cannot rely on that to make a diagnosis. This is all changing with this technology at AIML, and we feel that this is almost like when Bill Gates started Microsoft and said, I need investors in Microsoft Office. It's software to go inside these computers, and you can invest, in the seed shares. And people are going, well, what is software? Well, you can't use the hardware unless you have the software. Well, in a way, this is all software based on an algorithm that gets embedded in any hardware device. So it's device agnostic. So we believe that this company has a very strong ability, a chance of becoming the standard of care in how people look at their heart health. And because you can do it through a wearable, you don't have to just rely on the fact that you have to go to a doctor once a year and go on a treadmill or just have a stationary test done. It can be a continuous ECG that goes to a computer, and then with AI, because this involves AI, you train all the databases. So if every heartbeat could have a constellation of data, and we can see that data within that heartbeat and measure it against all the files of previous people that have had ECGs, and you can pick out minute abnormal patterns that previously were not detectable. And then those are the precursors to potentially some type of heart event or heart issue. So this is a company that we were involved in one way. It kind of pivoted a bit because we were extending, sort of working with wearables. We discovered this company out of Edmonton, Alberta. We bought it. The company's been spending months. It's developed its products. It's basically filing patents. It's filed with the FDA. It is a company to watch, and we are extremely excited about it. It's one of our major investments in 3D Capital.
It's clearly a standout, and it's always heartening to hear about those innovations that fundamentally improve people's quality of life. They not just help you diagnose, but also prevent some serious health issues, which is really great. And you clearly care about those companies and their success in the tech sector. But apart from the tech sector, you've also placed a clear emphasis on junior companies in the precious metal space. Why precious metals specifically, as opposed to critical or battery metals, for example, which are also gaining investor attention?
Yes. Well, we probably have some in the battery metals as well because we do have some, nickel, copper, cobalt companies, other copper companies. I have a background. I used to be an analyst I'm a CPA by background. I was an analyst and working on resource funds, in my early career. And I've been able to select companies quite accurately. We've had many, many exits over $1 billion where we've started these types of companies. So my view is that the world's going to need resources, metal resources. I'm believing that the U.S. debt is too high, so gold should be a part of your portfolio. So we do that in the same way by trying to find mines that didn't exist there before, and that's proven to be very lucrative to our investors in the past.
And let's go back to your portfolio. Looking at the big picture, with over $40 million in net assets, how do you manage portfolio risk and volatility across such a diverse set of early stage investments?
So we're not like portfolio managers like in other funds. Volatility is unfortunately, we have to accept that. We don't try to trade the market or anything like that. If we have a company that suddenly has zero in sales, but we help it get 10 million in sales, the company's enterprise value can go from 5 million to 100 million, no matter how the market does. So we're very much focused on building the companies as though it's your own operating private business. So we really, we try to be in areas that hopefully will generate liquidity for us because we need liquidity ultimately, because when projects do really well, we exit some, and that's how we end up investing in the new ones. So we're on top of our portfolio daily, and we're in touch with all the CEOs and founders.
So you clearly provide a lot of backing to those companies and care about seeing them succeed. And you've had an impressive track record with numerous successful exits. So what advice would you give to young, up-and-coming investors looking to follow a similar path?
Stay focused and be patient. Many times, people look at and do your homework. People listen to what other people say, then they change their mind and they go from this to that. And you have, I would say, be comfortable with what you're investing in. Do as much homework as you can and just be patient and stay the journey.
Yeah, patience is definitely a must when it comes to investing and seeing those investments bear fruit for sure. My last question is about 3D capital. Why should investors invest in 3D capital rather than individual stocks, for example?
No, that's a very good question. Well, we have diversification. We have approximately 60 companies. So you have many opportunities for success, and no individual failure will make everything go to zero or so forth. And so I like to say we have many, many horses running in the race, and the chances are you're going to be in the winner's circle with one of those horses. So what we provide is an opportunity for those that are interested, is entry points at a seed level that is not available to the average investor. They're just not available because you have to be a professional investor to almost find them. And then second is, once you made the investment, how do you stay on top of it? And other than quarterly filings, these management teams aren't going to tell you what's going on. We have a much preferred seat at the table, so we can not only get in at a very low valuation, but we actively manage it and we add value. So we're kind of very unique in that regard.
So you do the homework on behalf of the investors and provide the diversification and also provide the backing to see the companies succeed.
Yeah, that's right. And we've had a lot of experience. So, and we think this is our year now.
Absolutely, yeah. Well, best of luck to you. Thank you so much, Sheldon Inwintosh, for all of those insights you have shared with us today. We look forward to seeing you again on this show very soon.
Okay, well, thank you for having me.